Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you the three different types of trade setups that you're going to get when you come into each and every earnings season. There's so many different opportunities, but I've broken it down by three potential type trade setups. So trade one, when we're getting into an earnings season, this is CRMs to show you an example of all these three trades. So when we look at CRM here, you can see price action here where my arrow pointer is. It starts to trend up. All right. So a lot of times you'll get a trend into the earnings date, which is the date of the earnings announcement or release. So you can see here where my arrow is. This is the earnings date for CRM. So you can see how nicely it's trending up for the price. So what you want to do in this type of trade setup, you want to trade by going long the options. Okay, so long the calls in the series of your option series that's going to have the earnings release. So what happens is you're taking advantage of this blue line is the implied volatility increasing. So that is one of the major pricing components for options, time value and implied volatility. So as that goes up, that increases the value of a call option in that option series. So you can see here you would be getting a really great gain on the call options because you're getting the options going higher based on the price direction. So the delta is increasing, but you're also going to get an increase from that implied volatility. So in this trade, that's what I call trend trade one, a pre-earnings trend trade. You want to though be out, take your profit or get out before the earnings announcement. So right here you can see that. Now when that happens, you want to get out for sure the day of or before that happens. So take your profit in this example of trade one, and then if you want to trade for the earnings release, that's a separate trade, what we call a non-directional. So when we get into the day of the earnings release, you want to put this up before the, for example, CRM would be doing their earnings announcement after the close. So you want to have this trade set up before the close of that day. But you can see that the potential for it to go up or down is very, very strong. So we don't really know what direction it'll go from an earnings release. So you want to do this as a non-directional trade. And there are a number of different ways to set this up. One, we can do a trade to set up for a big spike up or down, or we can do a trade set up to take advantage of the volatility collapse. Here you can see how the volatility then collapsed after the release. Now the third trade is what we call a post-earnings trend trade. So a lot of times you'll see the market, after the earnings release, it'll stabilize and then either trend up or down. In this situation, you see CRM started trending back to the upside. So this gives you three potential trades for one specific stock, or you might have one out of two, one out of three or two, but there's a lot of opportunity. So here's an example to show you what that looked like on Apple doing the same type of trade, but doing it as what we call a pairs trade. So here's just another way to trade a pre-earnings or post-earnings trend trade without having exposure to the overnight market. So this is what we call a kind of market neutral trading strategy where you're long and short. So in this example, this was Apple on its last earnings. The earnings were going to be on October the 30th right here where this yellow line is. And so this was a trade set up to go long Apple and short match it or pair it with QQQ as a correlated instrument. And so at that point in time, right there on October 17th, Apple was trading at $41.93 per share over QQQ. And then right here on October 28th, before the earnings release, it was trading at $51 per share over. So that's an increase of $9.07 per share. If you did this 100 by 100, that's a $900 or $901 per 100 share profit or increase in that spread. And you can do these with options using what we call a synthetic option structure. So it just gives you a lot of flexibility and a lot of different things you can do every earnings season. So embrace it, embrace the volatility. And if you'd like to learn more about these types of strategies and the weekly option strategies that we use, join me tomorrow night. I'll be doing a final free webinar on how to trade earnings and the strategies used. So use the link here on this email video, and hopefully I'll see you tomorrow.